Guys, we may have just seen the end of the return to normal phase, which is what happens after a bubble pops and the markets make a big rebound and fool everybody into thinking that everything's back to normal again and that the worst is behind them and that the market's going to just make new all-time highs into a new bull market, when in fact what happens is the bottom drops out again and reality catches back up to everybody, shocking them and making them left holding the bag. Now, last episode, it was about retail, investors, the mom and pops, you and me and all that, getting rugged, right? Having the rug pulled under them, because what happened was last week they piled in, and at Friday after the market closed, Moody's came out and downgraded the United States debt. So, were retail traders dumb to get in at that point in time? And if we look at what happened actually on the Monday open, they actually came in with a vengeance. So after the Moody's downgrade, there was a gap down into the Monday session, and the retail traders came in and bought a record $4.1 billion worth of stocks during the first 3 hours of that Monday's trading session, right? And this was a Six Sigma plus event, meaning it was it was a world record, right? So they had been buying a lot, and they just literally bet the farm on Monday after the Moody's downgrade, and you can't blame them, right? Because they've been trained just like the Pavlovian dog to always buy the dip, because buying the dip resulted in profits because the market would always come back. And so when there was a downgrade because of the Moody's downgrade, or there's a downturn and it gapped down, well, they did what they were trained to do, which is to buy the dip. And so they did, and they did it with a vengeance. Now, usually when you see this kind of action, that's usually an exhaustion top, meaning and you also see this in the opposite direction. When there's a market bottom, everybody just sells, right? And that's when the market actually bottoms and we go back up after everybody unloads. We have this opposite over here where everybody just FOMO bought, right? Fear of missing out. They just came in and bought double hands over, buy, where it caused this record buying spree, which is probably the same as a record selling spree and an exhaustion at the bottom of markets, probably the same with the top of the market. Now, what happened after that Monday was the stock market essentially started just deflating, right? So we would start going down, we would gap down in the following days, and then on the morning when the markets would open, the retail traders again would come in and buy. But then it would deflate again throughout the day, and then at the end of the day it would be sold, because at the end of the day is when the institutions and hedge funds and fund managers come in and position themselves, and they would sell, because as you know, as you've been watching me in the past episodes, that the big funds are all short the market and reducing exposure, whereas the retail people are the ones who are buying and keeping the market up. And so the market was just continually deflating all of last week and even until Friday. Now, if we look at what happened on Friday, our dear POTUS came out and said, look, we're going to put a 50% tax in the EU because, starting in June 1, he's going to recommend this because they just suck, basically. And then he also added that any iPhones made by Apple was subject to a 25% tariff if it was not made in the United States. So that further caused the market to tank before, when the market opened, and then it was again bought by the retail traders. And then at the end of the day, the last 15 minutes, it was sold by who? The big institutions and fund managers. And this pattern has been going on. That was basically all of last week. So the jury's out. Did retail get rugged? Well, they continue to buy the dips even now as the market has turned and going down. And I feel like they're going to be buying the dips again, right? And we call that catching a falling knife. You catch a falling knife, you're going to get sliced with your hands. And they're probably going to be trying to catch falling knives all the way down. So what is going on fundamentally? Look, the stock markets are interesting and fun and that's where my positions are. But really what we should all be watching is the bond market, because the bond market is just straight up going, down. And if you look at what's going on is the yields, and this screenshot's actually not the highest that it's currently at, because we're above 5% on the 30-year and a 4.5 on the 10-year. And even the 2-year was at 4%. So the bond market, as I also described in the last episode, continues to implode, right? And yields in the United States debt is just skyrocketing. And this is fundamentally, and this is just the U.S. right now, as I showed in the last episode. It's not just the U.S. It's the entire world, all the developed nations, most of Europe, Australia, Canada, and Japan, the big one, all having rising yields. They've kind of lost control, the central bankers, of interest rates. And the reason why this is really bad is when you have high interest rates, it just slows down business activity, because it just, the cost of money, which is basically what this represents, goes up. It's expensive. Money becomes expensive, meaning it's expensive to take a loan out, to borrow money, to do something with it, to multiply that money after you borrow it, right? So mortgage rates over 7%, which we haven't seen in such a long time. Now mortgage rates over 7%. Like, who's going to buy a house with inflated prices with that high a mortgage rate in the US? Businesses trying to take out loans, long-term loans, very expensive. You're going to be paying a lot, right, in interest. And the big gorilla there's two big gorillas. There's one, which is corporate debt, which is huge. It's like into the 300 plus $billion that's coming due this year. But the even bigger gorilla is $7 to $9 trillion that the United States as a nation has to roll over this year. And you got to remember, when the United States bought that debt, right, to service its debt, because U.S. is over 30 trillion in debt, $35 trillion in debt. So it has to borrow money. When it borrowed that money, the interest rates on that loan was like, I don't know, like depending on when they bought it, but if they bought it around COVID, it was like really cheap, right? It was like under like 1%. And now it's at like 4%. We're talking about a, triple to quadrupling of the cost to roll over $7+ trillion of United States debt by the government this year. So this is a really, really bad situation for the United States government. Forget the stock market, right? Stock market is the smaller market. It's the dumb money. It's where, people, traders like you and me go on, whatever, right? But the bond market, especially the sovereign debt market, that drives everything, right? It's the larger market. It's the market with all the professional traders, not Joe Blows like us, but like actual professional traders moving billions of dollars and hundreds of millions of dollars, pretty much, right? There's no retail traders doing these trades over there, buying U.S. treasuries, unless you're like Warren Buffett, right? So that type of acumen and knowledge is in that bond market, which is a much larger market than the stock market, and that drives everything, right? So if this thing implodes, and watch out for Japan, right? Can't emphasize enough what's going on with the Japan. The Japanese yen is like, and we'll get to that in a second. But anyway, look, before I go off on a tangent here, this is bad. Very bad, continues to be bad. Yields are going up. There's no stopping the yields going up no matter what happens. And if you don't understand this, right, look at this, okay? Just look at the time frame we're talking about here. 1936, we're talking about almost a century's worth of data here, right? U.S. Treasuries, which is government debt, has just collapsed under a level that's negative now. We're at negative 0.6%. This, my friends, is a generational change that is happening before us. Recognize that, right? In 100 years, this has happened, right? This is, I can't emphasize enough, we are seeing a systemic shift in the way things work. And you see that, and I'll talk about it later, in other markets, such as the gold market, right? Why is gold all of a sudden skyrocketing? It's because this is happening. People understand that if there's going to be some like reshuffling and shift in the way things work, one of the best places to get into is gold, because that helps you translate from the old into the new system, because that's never going to go away. So you park it into gold, and then when the new system and dust settles down and the new system set up, you then use the gold to get into it again, right? It's a great translator or bridge from the old to the new system. And that's why gold's going up, along with Bitcoin too, which I'll also talk a little bit about near the end of the video. So yeah, the dollar is just, people thought the dollar made a comeback. It's going back down, right? And it's probably, look, if we break this low over here, look out, because the dollar is going to just go down, which is actually what Trump and Bessent wants. They want a weak dollar, right? Which helps U.S. exports. They want a weak currency. But watch out, because with a weak currency, what imports become more expensive, right? That's how you get inflation, right? And so you're going to have this is why I've been talking about stagflation for about a year and a half now. and we are staring at stagflation right in front of us, right? It's about to happen. And don't underestimate what pain stagflation brings, if you remember what happened in the 70s. Now, let's talk a little bit about what's going on with the stock market. We are essentially parked at the 200-day moving average. This is the SPY, right? The ETF. We are parked, we hit the 200-day moving average and we kind of did a little bounce on it. Now, this is a very important, line that everybody watches, right? We cracked through it, and then, on the way down, then we tested it before and we couldn't make it, and that caused this huge drop. Then we made this huge comeback and we gapped over it because of that China deal, right? So we just completely, everyone's like, hey, are we going to go up or go down here? And what we did was we did a complete gap on top. And horseback rode that thing because of the China news on the tariff deal. And we went up. Now what happened was, as I said, after the Moody's set up, we had this big buy on Monday. But then ever since then, we've been just deflating, right? And was that the top? Perhaps, right? And so we're now right down here. So this is a very precarious situation. If we go gap down on Tuesday, Mondays, and more or less, so markets are closed. But if we gap down beneath here, look out below, because we are heading back down. Now, if you look at this pattern, right? We went down and then we went all the way. People are like, we're going to go up. We're going to go up. Yay. I mean, nobody knows for sure, but I'm very, very skeptical of it, because I do think this is the end of the return to normal. Now, what do we mean by the end of the return to normal? This is what I mean. Now, this is a pattern that has been, everybody has seen. I mean, if you haven't seen this pattern, you should learn it. Most of you have probably seen this pattern. And it's from many, 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 many years, going all the way back to the tulip bubble mania. People have figured out that this is basically, what this represents? It represents human psychology in aggregate. And that never changes. That's why over hundreds of years we keep repeating the same damn thing. Because humans, greed and fear never change when we put a bunch of us together in a room. We act this way. It's kind of like the Dunning-Kruger effect, right? Where you think we're experts after we learn a little bit. Anyway, so this return to normal is, it's a bull trap, right? You think we're going to go, but no, what happens is, no, it's not return to normal. We go back down here. And if you look, it happens after initial pop, drop after the top, and we go up, fooling people, and that's why it's a bull trap, that we're going back to normal. And that's kind of like what we did. We had a top, and it popped, and it dropped quite a bit. Now we went all the back, and now everybody's thinking, hey, it's a return to normal. Is it the return to normal? Because if we go down here, look out below, we'll be taking out, over the next months and years, some new lows on our way. Now, there's a good question in my last, in one of the comments in my last episode about, hey, you can't you're laughing at all the people doing an analog of taking today's chart and picking a year from the past and overlaying and saying see, this is it's tracking it. This is what's going to happen. And the person who commented said that, well, I was doing the same thing by taking what's happening today and saying it's like, oh, it looks like 2007, 2008. Oh, it looks like 2022. There's a big difference between what I'm doing and what other people are doing, taking one chart from the past and overlaying it into the current chart and saying this is what's going to happen. That's a one-to-one overlay. I'm not doing that. What I'm doing is I'm overlaying everything on top of this well-defined pattern that over hundreds of years has been back-tested with many, many, many situations. Again, from the tulip mania all the way to today. And because it keeps happening, there are many time periods where basically the stock market followed this pattern. And so what I was comparing is the base pattern, what's going on today, with previous incarnations of this base pattern and seeing how we're tracking it today, which is very different from a one-to-one direct mapping. So I just wanted to clear that up in case any one of you were also wondering about the same thing, because it was a legitimate question, but I hope that clears that up. So this pattern, where have we seen it before? We've seen it many, many times before. Look, this was the Great Depression, okay? 1922 to 1930. What happened? We went, boom, we went down. Oh, return to normal. Not really, right? And that's what happened in the Great Depression, 1920, 1929, 1928, right? That's basically the pattern. Where else did it happen? Well, it also happened in the dot-com bust, right? This is NASDAQ. Woohoo! Boom! Right? Crash. Then what happened? Return to normal. Hey, everything's going to be okay again. We're going to go back all the way up to the moon. That, this was, no, that was just a correction. And so everybody bought this, and everybody right here, I guarantee you back then, and I was there, well, everybody back then when we jumped up this much was thinking, look, we're going to go back up. Woohoo! New bull market. No. This happened afterwards, right? See the pattern? You see that pattern? You see that pattern? You see that pattern? Yes. We've also seen it in, basically, this is the 07-08, right? What happened here? Boom. Top, boom, crash. Then what happened? Return to normal, like huge rally. It was like 20%. We're going to go up. We're going to go up. Yeah. No, that didn't happen. Went back down, right? Return to normal ended there. Guess what? I mean, I could go on and on. This is Bitcoin, right? And Bitcoin actually had a bunch of return to normals, which is great. And but before I get into that, look at this. This was what? Bitcoin in 2012, 2003. Look, boom, right? Pop, go down, return to normal. Didn't happen, went down. Then later on, boom, even bigger boom, right? Drop, return to normal. No, went back down. So I hope you're getting the point here. This is a very oft repeated cycle that especially happens when we have like such a crazy run up, which we've had in the stock market, and then we have this huge pop and drop followed by a return to normal, right? And so that's what I do believe is going on right now. Now I do want to talk a little bit about Bitcoin, and you can actually see it in this chart. I'll talk a little bit more about it. You see, the thing about Bitcoin, everybody, and I used to be one of them, right? The doubters in the early days. I come clean. I'm not going to deny it. I used to think it was a Ponzi scheme, right, in the beginning. And there are people today who are like, oh, Bitcoin's a scam, it's a scam, scam. But the one comment I make that always ends all the conversations is this. There has never been a Ponzi scheme or a scam or a bubble where after the bubble pops and everything collapses like 70, 80%, pretty much pops and dies, right? That then comes back to create another bubble that pops and comes back and then comes back again. It's like freaking Lazarus. Lazarus just won't die, right? That's Bitcoin. And that after the first pop drop and then it came back up, I knew it wasn't a scam. Because no scam or Ponzi scheme comes back up, right? If it comes back up, that means the underlying asset actually has value. But that value gets overtaken by speculators who drive the price up and causes the volatility. But the volatility doesn't undermine and take away the underlying value of the instrument underneath it, right? And that's why it keeps coming back. If it was a true Ponzi scheme or a scam, right, then it would never come back because there was no value underneath it to begin with. So once the jig is up, it's gone for good, like the tulip mania, right? Or the South China Sea trade, all the other bubbles and scams, they never come back. They're once and done, like a one-hit wonder, right? Bitcoin is not that. Bitcoin keeps coming back. And that should end the conversation as to whether or not it's a scam. It's not, right? It's just something that has underlying value that is quite valuable. And the speculators come in, right? And they do the volatility thing. And that's why you see the crazy pops and drops of Bitcoin. But over time, it goes up, right? And it's in the early days. It's in its infancy. So you got to give it some time to grow. But, just keep in mind what I said. For that simple reason, there is an underlying inherent value that is created by humans, us. We give it value, right? That's here to stay. That's just a fact. Like if you don't accept that fact, then you're just biased into not believing reality, right? And so that's my only thing I got to say to people who keep saying Bitcoin is a scam. And it's not. No scams ever come back over and over and over again. That's just a fact. If you don't want to believe it, go live in your alternate reality or simulation. Okay, so gold is the other one that, like I said earlier, gold is a good translator from an old monetary system into a new monetary system. It's a bridgeway, and I think Bitcoin might be one of those too. Now, if you look at the history of gold, which is a lot older than Bitcoin, right? So now we're going to go back all the way to 1860, right? Because we actually have data going back till 1860. And obviously gold's been around since freaking, BC, 5,000 years, right? 3,000 years before Christ. But we actually have data going back to 1816. You see this very interesting cycle, right? It's like every 31 years-ish, we do this, right? And this is a very important point. So right here is when Nixon cut off gold from the gold standard, meaning we went into, printing money, fiat currency, right? So you can just print as much dollars without having the commensurate amount of gold in your bank vaults. And that caused this to skyrocket. And, this era, which is post, Nixon cutting off the gold standard, is a different era to what was before, right? When you had to have enough gold to print dollars. So in this era, we've had this 131-year cycle, and we're in the middle of another 31-year cycle. But 31 years since 2011, I mean, we're talking about, what's that, 2042. So 2042 is around the year we're going to end, right? And this chart was created by, I guess, Owen Analytics, and back in 2004, 2024, when was this created? 2024, right? So it's been a year. So we've already eclipsed 3,000, right? We're today already at $3,400, right? So the dotted line is the real price of gold, and the solid brown is the real price of gold adjusted in terms of 2024 dollars. And we're already gone up here, and we still got a many years to go. So this is why this, along with all the other charts I've shown you, we're still in the kind of the early innings of this gold secular bull market, and we have a lot more to go, right? I mean, people believe 3,400 where it is now it is high compared to the past, but compared to where we're going to go, I mean, we're going to go much higher. Mark my words, and try to, the game now is trying to find a good entry point, good discount windows to accumulate more gold. So here we are, with gold, and as you know, I'm a big, investor of gold. I have gold bars and blah, 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 blah. But, what happened recently, okay, back in April, we had that top, right? We 3,500, then we came back down and made another run at it. And everybody was saying, look, it's a double top. That means, boom, it's going to go down, double top, right? At least down here and further down. Maybe down here, up and down. Head and shoulders. But clearly, that didn't happen, because once we went down here, which the official definition of a double top is you break the neckline, which is here, and we broke the neckline, and that was a head fake, right? That was a bear trap. Everybody was bearish gold, saying, oh, we broke the neckline, double top, we're going to go down. And what happened? We just shot right back up. You got to love it when, that's why, man, you got to be careful out there, guys. Everybody knows all these double top patterns and head and shoulders and all. They will just wreck you, dude. They'll bring it down here to make you think that it's a double top breaking the neckline and just rug you on the way up. But basically, that's what happened. And this, gold just keeps going up. It doesn't matter if inflation's hot, inflation's cold, market GDP goes up and down, sentiment up and down, tariff on, off. It's like the yields, they go hand in hand. They're just going to go up, right? Because the underlying system itself is slowly cracking, right? And that's why those two things will just continue to go up no matter what is done. The long game is over, and people are beginning to realize that, and they're starting to prepare. And I highly recommend you do the same, because within our lifetime for sure, the financial system is going to get reset. And the question is if we're going to have a couple of hot wars with that, plus a digital war, or not. Now, I just want to spend a second here and talk about Bitcoin. Now, if you look at Bitcoin, I mean, this is what I mean. Like, how many, parabolic rise? If I hit everything to this right, and you just saw this parabolic rise, that's crazy. It popped. Another parabolic rise popped. This one was kind of like a double top, and we did break the neckline. Then another parabolic rise, and then we had a bull flag. Then we came up and we tested the previous high down here, and we went all the way up, and now we're at new all-time highs. This is, my friends, Bitcoin is not. This is what I meant earlier. There is no way a scam will do this after popping so many times. It is only because there is an underlying value to the asset that it keeps going up, and the speculators keep coming back in to drive the markets higher than it probably should go given the amount of time, because everybody wants to get rich and become a billionaire tomorrow. And that's what causes this volatility. But make no mistake, we are on a trajectory that is going up. And that's why I also recommend having some Bitcoin, but with a reduced exposure compared to gold because of just the volatility, because the speculators like to come in and mess things around along the way up. So having said that, let's see what happens next week. Is it the return to normal? Because if it is, we're going to see a continued drop down, right? Well, everybody's thinking, no, it's going to go up, more dip buyers, and they're just going to be catching falling knives and get completely wrecked. And as I kind of warned in my last episode, would be the confirmation that the retail folks, once again, got rugged by the big boys and the sharks in the stock market. So I'll see you the next week. Have a happy Memorial Day, and peace out.